Good morning, everybody. Welcome to the discoverIE interim results for the 6 months to the 30th of September. I'm Nick Jeffries, and with me is Simon Gibbins. We're going to run through the slide pack of results. I'll start with an introduction and then hand over to Simon, and then back to an operational review at the end. So we're pleased to report that in this period we had very strong organic performance, record organic growth in orders, sales and order book, along with the underlying earnings per share. So orders were up 64% organically compared to last year. That's 34% ahead of 2 years ago, the pre-COVID period. Sales likewise up 15% and up 8% organically versus 2 years ago. And the order book up a very strong 71%. So that, along with tight cost control, has meant that underlying earnings per share are up 37% on last year and 18% on 2 years ago. I think the key point to really make, though, is that since we started to accelerate the D&M strategy 4 years ago, and 2/3 of our acquisition value has been made over the last 4 years, our organic growth since that, over that period, is 9% CAGR, and underlying earnings per share 17% CAGR, bringing in the benefit of the acquisitions. Along with along with our organic performance, we've concluded, excuse me, the exit from our custom supply channel with the sale of ACAL BFI announced earlier this month, and the sale of Vertex South Africa announced last month. That means that the group is now wholly focused on design and manufacturing, which is obviously the higher margin part of the business. So our underlying operating margin for the continuing business, when stripping out the discontinued custom supply division, is now into double digits for the first time at 10.3%. And we've therefore raised our targets, as you'll see later, to increasing our margin targets to reflect the disposal. The other thing to point out is that following the sale of ACAL BFI, and the proceeds from that, our gearing will be at less than 1, at 0.9 on a pro forma basis. So that obviously gives us quite a bit of horsepower for further acquisitions in the D&M space. Over the period, we've made 3 acquisitions for 85 million. So we announced Beacon and Antonova in September, supported by a 55 million equity raise, and just prior to that, CPI. All 3 of those acquisitions are performing very strongly, and we're pleased with the integration so far. You may remember that back at the full year results, we talked about the need or the expectation of seeing a strong recovery in project design activity. Well, we're pleased to say that that has happened. We've seen a very strong recovery in design wins as well as new project activity. ESG is taking up a lot of our thinking time at the moment and our actions. I'll talk more about that a bit later, but just to say at this stage that we have a lot going on in relation to reducing our carbon emissions, and I'll report on some of those details later on. We've also made a new appointment, which was announced last month, with Rosalind Kenya joining on January the 1st, with a specific responsibility for developing our ESG strategy and focus. H2 has started well. We'll talk a bit more about that, but we're running ahead, and as you'll have seen, we've upped our numbers this year on the back of the strong performance so far. Just a couple of words on ACAL BFI. So ACAL BFI completes the exit from custom supply to 50 million sterling enterprise value, which represents roughly an EBIT multiple of 7 times the pre-COVID average earnings. We're expecting completion by the end of this financial year, so sometime in February or March probably. Consultation of the French Works Council is underway, and we believe that we've got agreement with that, or are imminently going to get agreement for that. Regulatory approvals are required in Italy and Germany. We have already achieved that in Italy, and we're waiting to hear from Germany. If the approval timeline falls over into the new calendar year, then we'll also need to gain UK approval. But we'll see. We'll see where we get to with that, all dependent upon Germany. Cross-selling continues as it would have done before, or as it was doing before the sale. The only difference being that it has to run at arm's length, and so in many respects there won't be any great change to that. It's worth pointing out that we've added in about £1 million of extra central costs to support the investment in IT at the ongoing group centre. It's IT investment for the D&M division, and that will some of that will start coming in the second half of this year, but it'll annualise out at about £1 million. And just finally to say, the divisional reporting structure is under review. Obviously now we're a wholly D&M business, so we are looking at how we will develop that reporting, and we'll report on that in due course. We've included on these two charts here the revenue and underlying operating profits and margins for custom supply, which really just paints a picture as to why we felt it was appropriate to dispose of the business. It's lower growth with lower margins and higher cyclicality, so increasingly it was really an outlier from the sort of the dominant part of the group, which was D&M. So as a result of the disposal, then we've reviewed and revised upwardly our strategic targets. So you can see in the 4 charts there that our D&M target was always to have greater than 75% revenue from the D&M division. Well, that's now 100%, so that target will drop away from here on. But secondly, the operating margin, our target was 12.5%. We've increased that to 13.5%, which really is just a reflection of the removal of that part of the business. Internationalizing the sales, you'll see later on that actually the D&M business is a very sort of well-balanced international revenue profile, and that's important. I'll talk more about why that's important, but therefore we've upped our target to sales beyond Europe to 45%, and sales into target markets, our target remains unchanged at 85%. Again, I'll talk a little bit about that later, but we think that these targets, if we deliver all of these targets over the next 3 years, then we'll be 3 and a bit years, then we'll be in very good shape. Okay, with that, I'll hand over to Simon to talk through the finances.
Thanks, Nick, and good morning, everybody. First up the financial highlights. There's a good set of financial highlights here. Can I just a key point to start with? This is the continuing business results, current and historic, as required by IFRS 5. Post the discontinuation of custom supply. Second key point is we have shown, as you can see on that summary, the results for the pre-COVID period 2 years ago. I think that's really important to show the resilience of our business through COVID and also the strong growth coming out of that. So a really good period of progress. You can see strong growth in sales, profits, EPS, you can see is up 37% against last year, 18% against the pre-COVID period. Our margin, as Nick said, is now over 10% for the first time. We've continued to deliver strong cash generation, and that cash generation has reduced gearing below 1 for the first time in 8 years and gives us plenty of firepower for acquisitions. In terms of ROCE, ROCE is broadly on track with our target. Our target is 15%. We're a shade lower than that, but we have made 6 dilutive acquisitions. They're dilutive at the start of it, accretive from a profits point of view, but more dilutive on the ROCE, but that will pull back. So all of these, I think, really ably sort of demonstrate the business we are. It's custom product, it's capital light, organic growth in target markets, accretive acquisitions. This chart shows, as you can see, revenue for the last 9 years. I think it's really sums up, that is the D&M business, and it really sort of sums up what we've delivered in the last 10 or so years. So you're building a business up basically from scratch across that period. Nick talked about the really strong order growth. That's driving organic order growth. That's driving through into organic sales growth, 15% against last year, 8% against the pre-COVID period. And you can see good contributions from acquisitions. So that's very much the model we are. Organic growth augmented by accretive acquisitions. So 20% growth versus 2 years ago at constant exchange rates. And if you look at the performance over the last 5 years, we're growing at around 20% compound annual growth. So very, strong, consistent performance. That's driven, strong growth in operating profits. As you can see, we're up sort of over 4 million to 18 million, and again that is up 20%, 27% versus first half 2 years ago. And again, you've got that consistent performance, 28% compound growth since H118. I put two operating margin lines there. The lower one is the historic margin, that's including ACAL BFI. The upper one is the ongoing margin, and so you're seeing strong growth, on an underlying basis. So we've delivered 0.8 percentage improvement in margin this period, and it's up 3% overall, given the additional benefit that comes from the disposal. And look at the growth. Nick's talked, a very key metric for us is delivering growth in operating margin, and you can see we've delivered that across that, for a while, but there's a 4-year span there, and even with the ongoing margin, you've got over a 2% percentage points increase in the last 4 years, which sort of demonstrates the organic improvements we're making. This chart takes you from the pre-COVID periods, that's 2 years ago, the 14.2 million of operating profit, through to the profits this year of 18 million. I think that ably reflects the underlying performance of the business outside COVID. The first 3 bars that you can see there on the left, that is the organic performance, operating performance. So if you take it from the left, organic revenues up 8%, that's 4.2 million of additional gross profit. Gross margin, our gross margin is actually, not surprisingly, after the disposal of ACAL BFI, it's actually at a record level. It's nearly 39%, and actually when I started in over 10 years ago, the margin was down around 25%. So again, that sort of really demonstrates the change we've made, moving up the value curve, higher margin product. Importantly, we managed to maintain, there are a lot of supply pressures out there. Through this period, we've managed to maintain the organic margin pretty much on track. It's 2 pips lower, so only a small impact on the profits. In terms of operating, and actually, just in terms of that, I think again that really shows what our business is. We're priced by design. It's made to design, not to price. So we're managing to maintain those margins. In terms of operating OPEX, we've invested carefully. Coming out of the COVID situation, OPEX is up only 5% over the last 2 years. And if you take those 3 bars in combination, that's the organic operating performance of the group. That's a 16% drop through. I think that's pretty good. I put a bar there, which is head office. We've been upscaling. We're a growing business. We've been upscaling our central capabilities. So we brought in additional resource in terms of M&A. It's to help growth, but also to help governance. We've sort of augmented our team in internal audit and risk, and we've also recruited into ESG. And in terms of the second half, Nick talked about the IT, which will start coming in, but additionally, we're expanding our group executive committee in order to give us bandwidth to support the growth within that division. LTIPs, there's a line there. The impact, the NIC costs that we have on the exercise of options, that's been impacted very much from the share price growth. The share price is up 150% in the last 18 months. That impacts the NIC cost, as does the NIC hike that is taking place next year, as well as moving into EPS vesting metrics. Acquisitions, we've done 6 acquisitions in the last 2 years, and they're all contributing well to the model and adding 5.3 million to the profit line. And again, I think that really demonstrates what the model is about. It's organic growth with drop through, augmented by acquisitions. The division, as Nick said, we're down to 1 division for the time being, so not too much extra information on this chart. We've obviously talked about the sales. At the side, I think the key takeaways, if you look at the EBIT growth that it's delivering, 38% EBIT growth, 34% against the pre-COVID period. I think it really demonstrates the resilience of that D&M business. But also look at the margin. The margin's at 1.4 percentage points. About 0.5% of that is through the organic growth, and the rest is from the high margin acquisitions we're bringing into the group. So more on the operations from Nick coming up. PBT and EPS, this gives you a track from the 18 million operating profit down to EPS of 13, versus the 2 years. I think you can see the finance costs, tax are broadly in line. PBT up 38%. The key changes that you can see are the number of shares. We did a share issue this September, 6% placing. Shares up slightly this period, but versus 2 years ago, we also did a placing back in October, around the time of the Senstek acquisition, so 13% there. So EPS up 37% this year, down to still a decent level at 18% growth. And if you look at the chart on the bottom right, we're actually growing. It's 18% versus pre-COVID period, and we're growing at a 21% CAGR over that period since FY22. I'll just draw your attention to the bottom line. That's the reported EPS, so that includes the adjustments. That includes acquisition costs and amortization of acquired intangibles. It is lower than 2 years ago, as you can see, but that is the model. We've done 6 acquisitions this year in the last 2 year period. That's 165 million as we increase the growth potential of the group. Cash flow, we're a very cash generative. We've talked about this before. We're a very cash generative, capital light model. I think this table at the top sort of ably demonstrates that. You've got a walk there from EBITDA of 49 million through to operating cash flow of 40, free cash flow of 28, all important metrics for us. Working capital, you've seen a lot of growth. This is over the last 12-month period, as we typically put up at the interims. 4.4 million investment in working capital. There's been a lot of sales growth. We need the investment to support that. And in terms of working capital metrics, we've actually reduced the D&M working capital from about 18% of sales down to sub 17%. So we're really pleased as we continue to focus on efficiencies. CapEx about 5 million, but it still is a 12-month period, so it is still impacted by the restrictions we put in place. We moved to a sort of maintenance model during COVID. We're moving through into expansion, so you'd expect that. I expect that number to be up near over sort of 7.5 million for the full year when we get there, as we invest in additional capacity as well as rolling out some of our ESG initiatives. So operating cash flow 40 million. That's up 19% against 2 years ago. It is actually 16 million down on last year in terms of value, but actually there's a 22 million swing, that working capital swing that came about due to COVID. Sales down, working capital in, sales up, working capital back in. If you take the working capital out, we're 18% up in terms of last year as well. Free cash flow, similar sort of growth metrics in terms of free cash flow. You can see how we're sort of developing that, very important metric for us. The conversion is great. It's around about 95% for both operating cash and free cash flow. And you can see at the bottom our consistency of delivering, well above that 85% target in terms of conversion. This strong cash flow has helped reduce our gearing down to 1.3. Net debt at the period end of 76. And when we get the ACAL BFI proceeds, gearing will be sub 1. Target up to two times in terms of where we feel comfortable on gearing. So that gives us plenty of capacity alongside the facility that we have. Dividend. We'll put the interim dividend up again, 6%. Probably no surprise there. It's a progressive dividend policy, and actually it's sort of seen as double that dividend in the last 10 years. And actually in terms of the cash cost, that's up 400%, is around about a 10 million number. Cover equates to 2.3. Over time, we'll continue to grow the dividend, but we like to see it go above 3 to give us that combination of a progressive dividend and self-funding of acquisitions. Targets, we've continued to make progress on all of our targets. As you can see on this summary, Nick talked you through the upgrades we made in the KSIs. That's the top part of the chart. In terms of the KPIs further down, again, good progress, very good progress, as you can see. Strong growth in sales, strong growth in EPS, excellent cash conversion, operating cash and free cash. ROCE broadly in line with our 15% target. And in terms of carbon emissions, we're making very good progress on that, and Nick will update you. So with that, I'll hand over to Nick to update on the strategy and operations. Nick.
Thanks. Okay, so I'll skip over this slide just as a summary of the scale of the group. Now we've got 30 manufacturing sites all over the world now, which is increasingly important as the world regionalizes and as our customers continue to operate internationally. This is the key slide, really. Target markets are driving the organic growth. You can see on the right-hand side that so this is growth over 2 years ago. So 8% total organic growth is achieved through 13% organic growth in the target markets, offsetting a 6% decline in the other markets. And then on the left, you can see the target market revenues now account for 77% of the ongoing group sales. So we're really pleased with that. It's further verification that these are the right markets to be selling our products into. Our products are essential in the customer's applications when they use them. So once they're designed in, the customers need them, and getting them designed into markets and customers that are going to grow is what drives our growth, and that strategy is working really well. And we expect all of our design activity focus now is really on increasing the activity in these areas. And then this, again, the format of this chart will be this slide will be familiar. The key point is really the left-hand bar chart there. You can see the organic growth going back. So this is this is period on period and year on year organic growth going back to Q4 17, FY17. And you can see the strength of the organic growth over that period. And really what it's showing is several things. Firstly, the strong organic growth of around about 10% through the up cycle in towards the left of that chart. You can then see it starting to slow a bit in H1 and H2 20, really as the cycle started to peak and overstocking started to come in globally. And we were a little bit frustrated by the 5% growth in H2 20. That was a bit lower than we were aiming for, but nevertheless it was significantly better than the market at that stage. And then 21 obviously was COVID. And then in the right-hand bar, you can see just the bounce back. And so the resumption of strong growth is what we were expecting to achieve, and we're very pleased to report that. The central bar chart shows the growth by region. You can see there that Asia has grown 29%. That's year on year. So that's principally China, but also India. You can see that Nordic, there's only 2%, but part of that is because some of the major customers have moved their production to Asia following their end customers' demand. So that's the explanation for Nordic. Rest of Europe, that's widespread, actually, Central Southern European and a bit of Eastern European demand. So just sort of strength in pickup everywhere. Germany, is back on track with 13% growth, as is the UK. If there's any disappointment, it's the North American growth, only 5%. And the reason for that really is there's still some of the major rail projects have taken a long while to come back post-COVID. Although the orders have picked up in the States, you can see there the lag as a result of the time it took for those projects to get back to normal. And then on the right-hand side pie chart, you can see the revenue split by region. That's the kind of split we really want to be seeing, a broad-based international revenue stream. And then order book. This is really quite remarkable order book growth. It's just shy of 200 million. It's up 71% on a year ago, 54% on 2 years ago, and up 44% organically from the year end. So just a remarkable growth. Really two reasons really for that. Firstly, obviously our growth customers are ordering more, they need more. And in fact, we have felt the effects of the supply chain restraints limiting that growth in the short term. But also customers' order books have lengthened, they've got more confidence and they're also fearful of supply. So the average order book length has increased from a shade under 4 months at the height of the pandemic concerns last year to now just over 6 months. So the result is that order book growth that you can see driven by two factors. Design wins. So we said the last results session back in June that we were expecting to see a strong pickup during this period in design activity, and that's what we've seen. The design wins year on year are up 56% and up 10% on 2 years ago. I mean, really what we saw at the height of the pandemic as sort of fear set in, customers paused or withheld or that some of their project activity to just deal with the here and now. So we saw quite a drop off in activity, but what this is showing is the strength of that recovery. Also, our project activity pipeline has increased strongly. It's at a record high. We have a pipeline actually of over 800 million sterling of ongoing projects. So very, very strong indeed. And obviously, as I always say, the design activity is the driver of the organic growth of this business. So it's a very, very important focus for us. All of our businesses are focused on this. And you can see in this slide, we talk about 80% of the wins are in the target markets. Actually, that's down a little from previous periods. It's typically about 90–95% of our wins in target markets, but there is an element of all ships floating on a rising tide at the moment. So, but still, 80% in target markets is very good. ESG, well, there's loads going on in ESG. The main activity is on the sustainability and environmental areas, where we are installing and taking actions to source renewable energy. We've installed renewable energy sources in 2 of our sites now, Poland and Sri Lanka. Sri Lanka, there are actually 3 phases to it. We've completed the first phase, but those 2 sites make a very material, or will make a very material reduction to our carbon emissions. So we're very keen to see that come through. On the social side, we've stepped up our diversity activities quite significantly, both on a gender and ethnicity basis. We've done a lot at the group level, but we're also now starting to trickle that down into the operating companies and the operating company management. And on governance, there's a lot going on, and more than I can fit on this slide, but we've established a whole series of external supplier audit programs, anti-bribery and corruption revised policies. We're just about to embark upon our first external board evaluation program, etc. And in fact, if you look at the press release, you can see much more of the details that we're talking about on there. And in order to achieve a lot of these actions, we've added some resource centrally to help us do that. I won't go through the strategy in any great detail. There's no change to the strategy. It's a consistent strategy that we've had now for 10 years, more than 10 years. We're focused on sustainable growth markets, which are aligned with the UN sustainability agenda, and we focus on designing our products into markets that serve renewable energy, transportation, which is principally electrification, medical, and industrial connectivity, which is really about industrial and the connection with wireless and fiber connectivity. So going to the outlook, the second half has started well. We've got continued growth organic growth in orders and sales, which means our record order book continues to grow. We've got a very strong design win funnel and opportunity funnel. So despite the supply chain and FX headwinds that we saw in the first half, and that we are pretty sure that certainly these supply chain headwinds are going to continue in the second half, but despite that, we're confident that we're going to continue growing very respectively. We've got a good pipeline of acquisitions underway in the pipeline. Our gearing, as I mentioned, or Simon mentioned earlier, is 0.9, so we've got quite significant funding headroom to self-fund those acquisitions. And so the result of all this is that our trading is ahead of where the board had expected it to be, which is why you'll have seen a circa 4% upgrade to the consensus numbers this morning. So we're expecting the second half to be a strong half. And with that, that concludes the presentation. We'll now hand over